thank you, audience, for joining us today. And thank you to Tom, my great colleague here. It's a real treat for me to be able to work with someone like Tom. As was mentioned, he has spent many decades at the Federal Reserve System, was a president. He participated in the FOMC. He knows the Federal Reserve. He was an insider, and now he's a colleague of mine. He also worked at the FDIC, so he has a lot of institutional knowledge to bring to bear on this, as well as knowing the people. In fact, he knows Kevin Warsh. He was at the FOMC during his first time there. So, Tom, it's great to see you.
Thank you. Thanks for having me. And I'm looking forward to this conversation.
Yeah, me too. Now, you recently wrote an article on your newsletter. It's called Fin Reg Rag. And we'll provide a link to that. I believe an email will be sent to all of the listeners out there. And I would encourage you to subscribe to it. It's a newsletter that Tom writes every so often, and some of his colleagues, on all things Federal Reserve, financial regulation. It's a great resource. So if you're not subscribed, please do. But Tom, you recently had a piece in it that was titled Chairman Warsh Takes the Reins. What follows? And you went through a number of points that are very pivotal because this is an inflection point. Right? We have a new Fed chair, a lot of changes ahead potentially. And one of the first things just out of the gate that you mentioned, that even in a world where you didn't have all the political problems, you still are finding ourselves in a situation where it's going to be tough for a new Fed chair to come into. He inherits a fragile macroeconomic environment. So putting aside some of these other issues we'll get to later, tell us about that. The situation he's kind of stepping into the macroeconomic environment.
Sure. I don't envy him the challenges he has because we're in many ways, we're in both at a inflationary boom, as we see with new records every day, it seems to be in the stock market. And yet behind that is a more fragile economy than many people would like to see in terms of real disposable income not growing as quickly as some people would like, our savings rates going down. And so you're now the chairman of the Federal Reserve, and you have to come in and so what should monetary policy be in this environment? You have an inflationary environment, which means you should be thinking about the possibilities of having to raise rates when you're above 3% inflation now, and your target is 2%. At the same time, though, you're seeing a somewhat fragile employment market, and that's one of your mandates. You're seeing a slowing in growth. You're seeing the savings rate drop. So should you then be stimulating the economy as you look at this? So you've got this balancing act. We haven't seen quite this kind of a situation since maybe the 70s. But he is really walking into what I call a can of worms of trying to sort this out. So I wish him all the luck. Now, Kevin has experience, enormous experience, and he's a good diplomat. So we'll see how he maneuvers through the initial transition to chairmanship.
Now, you were there when Bernanke became chair, Ben Bernanke, that is that right?
Yes, I was. Yes, that was.
So you've seen transitions like this before where a new chairman of the Fed steps up and becomes the leader of institution. And the FOMC, the Federal Open Market Committee, it's a committee, right? You've got to persuade people. It's not a one-man show.
Mhm.
So you just mentioned, Kevin's been here before. He also is diplomatic. So talk about what he needs to do just right out of the gate to all his fellow members on the committee.
Well, a couple of things I would tell you. Contrast this with Ben Bernanke. When Ben Bernanke came in after Alan Greenspan, there was kind of a culture in the Fed that you should try and support the chairman. That should be almost your first priority if you can. And that was a pretty institutionalized view of things. But over time, and now we're in this situation where we have a more mixed FOMC. It isn't an automatic that they will support him. So he has to come in this transition, and number one, he has to establish his own credibility, and that will be on how he presents the issues to the committee and how he conducts the discussions within the committee, how much leadership he shows, how much deference he gives to the others, and that's the diplomatic skills he has to bring forward. But he has to try and get at least 7 votes, preferably closer to 10 votes on every vote if he can, and that means persuading And just so you know, the way the meeting works is you have the first part of the meeting, the first half of the meeting is updates from all the FOMC members, participants included, not just the voters. And then the next part is the policy discussions. What do you think should be done? He has to assimilate all that in line with his own views, and then he has to present to the committee what he thinks the best options are, and then convince him to vote with him. So he's got some big challenges out of the box. He doesn't have as the culture that Bernanke had, so he has to maneuver pretty carefully around this more mixed committee.
All right, so he has a tough economic environment he's stepping into. You got oil prices going up. You got war, inflation. You have an economy that you're not sure what's going to happen to it going forward. Potential weakness ahead. And then on top of that, he's got a committee. He's got to corral, and he's got to try to bring together. And you've been a part of that experience in the past. So I imagine he's probably busy right now, using those diplomatic skills, making calls, visiting people, trying to get something going. Because he has a meeting coming up really soon, right?
Yeah, in June here, and you're right. He's going to be talking with these members, the voters first, one on one, by phone if he can. If he has to, I should in person for the members that are at the board itself. Getting to know them, trying to see if there's some common ground here. I think that will be particularly important as he deals with individuals like Chris Waller or Michael Barr, who have already put kind of their own positions out, put something in the ground on that. So he will be spending a lot of time doing that. Plus, he is going to be working with the staff, the economics, and the economists on staff, being briefed, asking questions, getting his own thoughts organized. So he's working 24/7 right now. I'm sure you.
Yeah, so he's got to deal with the politics inside the Fed, but then there's the politics from outside the Fed. One of the reasons he got this job because the chairmanship's become very politicized. President Trump wanted his person, didn't like the previous chair, Jerome Powell. And that kind of leads us to this next point you talked about, and that is the Fed's independence is under pressure. And it's not just from the president, but also from from fiscal, with the deteriorating fiscal position. So maybe walk us through the challenges Fed independence faces.
Well, let me start with the fiscal and the monetary, and then I'll come back to the what's expected, and that is he has a major problem. He has put out that he would like to see the balance sheet of the Fed shrink. That's a tall order in and of itself as you go forward, because the economy is growing. To think you could shrink it's going to be a very difficult play. He knows that. And then on top of that, you have a growing debt. You have $2 trillion in new debt, $500 billion per quarter, and someone has to buy that debt. And the Fed has been a buyer. And starting in December, it started buying again. It's bought about $200 billion worth of short-term securities. There's been a little bit of reduction in the mortgage backs. But that's a big challenge for him to try and think about how I shrink that in an environment when the debt's increasing. And if you don't monetize some of that debt, what the implications are for rising interest rates, and in an environment where you're not sure if that's going to be the right move. So that's number one. Number two, and to your point, there is, I think, in the administration, and maybe in Congress, but in the administration, an expectation that this will be a more cooperative Fed than the Powell Fed, although Chairman Powell actually did lower interest rates and grow the balance sheet. But the fact is, this is now an expectation on the part of this new chairman. So he's going to have to he's going to have to establish his own strong views up front. He's going to have to set expectations, both within the committee and then with Wall Street, and then with the White House. Not an easy thing to do, and still stay on everyone's good side. And you can imagine how difficult that's going to be. And I think, I'm hopeful that given the amount of inflation that has kind of overwhelmed things at the moment, we have the inflation rate 3.5% or better, that the White House and Wall Street do not expect him to lower rates in June. That gives him a little breathing more room to think about it, move forward, see how the war in Iran goes, see what happens with oil prices. He needs that room if he can get it. But regardless, there is an expectation that he will kind of cooperate with the administration. How he sets those expectations, I think everyone is watching with bated breath, to be quite honest.
Yeah, so here's hoping for at least some honeymoon period for Warsh if he takes the helm of the Fed. Um,
Exactly.
m- Maybe let's talk about why we care about Fed independence. We've kind of asserted it, but what's the big deal?
Well, I think it's important that we use the word independence. I think we need to use it with care. We need a central bank that is insulated from short-term political um, lobbying, if you will, or encouragements, because it's the nature of the politician. I think everyone's watching this knows that they're very short-term oriented, as recent events have kind of shown us. They want lower interest rates because it gives you an immediate stimulus, even though the consequences may be uh, more difficult longer term. You get that immediate pickup, and that's what you go for. So you need a Fed that says, "Well, wait a minute, I know what you want, but we're in it for the long run. Our goal is to give you stable prices over time, a moderate environment for interest rates, and maximum employment. And we can't give you maximum employment or moderate interest rates if we don't give you low inflation. And so that has to be uh, protected. That ability to do that has to be protected, even though the central bank has to be accountable to Congress. That's who created it. That's who has ultimate responsibility. So they have to be very careful. They have to make sure they're communicating for the long run interest, so that then those who know that they're seeking short term solutions understand that sometimes the Fed has to say no. And that's a tall order, but it's absolutely essential that in that period, you can say no and you can't fire the whole FOMC when you're unhappy with them. And that's been an essential element of the Federal Reserve since it was created in 1913 to this day. But right now, it seems to be under a little more pressure than normal. Not more pressure than in history. We've had other incidents
Yeah.
like this as well.
So one of the beauties of the Federal Reserve System is you have these 12 regional banks. You were the president of the Kansas City
Right.
Fed. I'm sure all the listeners know their local or regional Federal Reserve Bank. But all of you presidents get to bring in your perspective from your districts, and that also kind of insulates the Fed from, a heavy thumb from the White House trying to guide things. You have these presidents from different parts of the country. You're hearing on the ground what's happening to communities in your district. It's that is reassuring, the structure that we have. And I think ironically, if I remember correctly, the reason for that was to kind of like get power away from like New York City and the big banks. But what it's done in turn is help insulate the Fed, I think, in terms of independence. So preserving a healthy regional Federal Reserve bank system is important.
Well, that's absolutely right. But I would add that you know every the Federal Reserve is the third central bank of the United States, and one element that's always been part of that is a public-private mix for the central bank,
Mm,
and that public-private gives both accountability on the public sector, that is the board of governors who are appointed by politicians, and then the private sector, which are these reserve banks who are accountable. I mean, the board has oversight, but they're also accountable to a local board of directors of local business, consumer, labor, whomever's on that board. And those boards are part of the selection of that president along with the board of governors who have to, in a sense, confirm their choices. So you get these presidents from the region who are I tell people they have they're embedded deeply in the local community. They know the business leaders, they know the business bankers. They have this information that comes forward to them in real time on a real time basis, and they can take that to the meeting. And it has credibility because it is from the ground up. And so when you sit in those meetings, those presidents are, in a sense, painting a mural of the economy because the economy in San Francisco or in the western part of the United States is sometimes very different than the economy in the southeastern part of the United States or the Midwest. And so you bring that together and you can find with that information a better base for consensus when you finally get done with painting the mural. And I think that's extremely important and gives credibility to the Fed, which also then gives it more insulation from the short-term demands of the politician.
Yeah, so it's quite a structure, and again, you're part of that legacy, Tom. You were there. Now, again, we like independence for the Federal Reserve because we want it to make the right informed choices. We don't want it to be pressured into generating inflation at some short-term gain and a long-term expense. And you know, I like to think of independence, Tom, along four dimensions. And I'm going to read. I'll list them to you, and you tell me which ones you think are the most important right now. And you've already told me, but this to kind of slice and dice this a little bit more.
Yeah.
So there's like the legal dimension to the Federal Reserve's independence, and that comes from the Federal Reserve Act. If there's it's in code what they can and can't do. I think that's probably not in danger or jeopardy. There's the political dimension, the norms. What does the president expect or say or do? We've touched on that one already. Then there's also, I think, a financial dimension. Can the Fed operate as an entity without being under pressure? And traditionally, it's generated profits from issuing money. It's called seniorage. But as you know, Tom, recently it's been losing money, and that actually it doesn't affect its ability to do monetary policy, but it does put pressure on it politically. It becomes a politicized point. And then the last one would be economic independence. Can it truly act independent of if fiscal pressures, are they far enough away that they're not being a problem? But if there's fiscal, deficits, then there are. So I guess those last two, financial independence and economic independence, are probably the most pressing ones.
I think that's right. I think part of it, though, let me back up just a little bit and go to the legal because one of Kevin Warsh's issues and my issue is this idea that the Fed has gone outside its lane. It's
Mm.
taken on more and more responsibilities, which I think in some instances were kind of legally on the margin. Um, Underwriting corporate debt or supporting corporate debt in a crisis at all, you feel like you have to do it, but it's really not within your purview. That should have been Congress providing that sort of thing. So as it's gone outside those boundaries, it does what? It sets expectations that, well, we can count on the Fed stepping in, so we don't have to. And this idea that went on when I was at the Fed in 2010, that the Fed is the only game in town is wrong. The Congress is the main game in town, but when the Fed steps in and relieves it of its duty by printing massive amounts of money, you've jeopardized your own independence. And that's, to me, a big deal, and I think a big deal to Kevin. I said, then on the financial, I think um, the world has come to expect the Fed to step in every instance that there's a financial stress in not only U.S. markets but in global markets. We see it with the swap lines, the so-called swap lines, where we actually loan our balance sheet to foreign central banks so that they have dollars, and therefore they can serve the liquidity needs of their banks who are trading in dollars and so forth. And so it becomes more and more pressure on the Fed to broaden its scope. And when you broaden your scope, you also others expect more of you. Uh, Wall Street is another element of this. Wall Street has come to expect the Fed to step in wherever. And you think about it, everyone talks about the stock market today and it's a new record this time and so forth. And there's a very strong presumption that if it gets into difficulty, the Fed will intervene. The Fed will save the world and therefore save the market. Therefore, it takes on more risk than it otherwise would. And I think has an expectation of the Fed that they will print the money necessary to do that. So the Fed has to be very careful, and that'll be one of Kevin's challenges to say, here is our boundaries. We're narrowing our boundaries again. That will be a huge challenge to him. And on the economics, it's even more difficult because here's Congress is involved. The, the fact is, if you're growing your debt, you're spending $6 trillion+ a year and have revenues of $4 trillion+, and that difference is only growing. Who's going to buy that extra debt every single year? $2 trillion plus roll over the old debt, and this is where you get the economics and the fiscal side really a challenge for the Fed, because if it says no to this and it says I'm not going to grow my balance sheet other than a certain very consistent rate sufficient to allow our economy to grow at its potential. So whatever that is, 3%, if that's what your judgment is, but you're growing your debt at significantly levels beyond that, and that means the market has to buy that. That's when you get the crowding out effect, because if the Fed's not printing as much money as it did, there's upward pressure on interest rates. One thing the private sector is rationalized out of the market with high interest rates. The government may not like high interest rates, but you don't ration it out. And therefore, it becomes ever more demanding of the Fed to print the money to keep interest rates from rising. And that is a huge, huge pressure point for the Fed. And it's one that Kevin is well aware of, I think.
Yeah, there's a great economist that you know well, Darrell Duffy from
Oh,
Stanford. He's done a lot of great work on the treasury market. One of the points he makes is that there's been these two developments. One, a lot of the new regulations after the 2008 financial crisis, Dodd-Frank and others, where banks have to be more careful with their balance sheets. They got to fund with more capital. As a result, they can't step into the treasury market as easily as maybe they once did. But more fundamentally, probably the bigger problem that he outlines is just the supply of treasuries coming into the market. So these big banks, these broker dealers, the institutions that were the primary facilitators of the debt, it's coming at them so fast they can't handle it. And as you alluded to, sometimes Fed has to step in to make the treasury market work. And so one of the interesting tensions is, for me at least, I think you've talked about this too, is the difference between keeping a treasury market, functioning normally versus stepping in and supporting the treasury market because you got a mild form of, say, fiscal dominance. So it's hard to know for sure between the two of them, but just as you said, man, we're running deficits of $2 trillion a year, peacetime, no recession. Interest on debt is larger than defense expenditures. And I don't want to get too scary here, but at some point in the future, if the debt stock was to get big enough, every time you raise interest rates, let's say to fight inflation, you're actually going to be injecting more money into the economy. If the stock of debt is so big, and this happened in Brazil in the 1980s,
sure.
the central bank there tried to raise interest rates to fight off inflation. They were following something called the Taylor principle or Taylor rule. Basically, the idea is you raise rates higher than inflation to kind of snuff it out. Well, what they found out is there's so much debt they actually generated more money going into the market to higher rates, which generated more inflation. So we don't want to get to that place where the Fed loses control, where we have runaway inflation. And so this is incumbent upon Congress to get its act together. I guess stepping away from the Fed briefly, Tom, is there any hope there? Any reason to think that Congress will get its act together one day and rein in these deficits?
Or you make a great point, and I think um, I'm going to make a couple points. But number one, to
Yeah.
answer your question, there is, I think, now I know there is a bipartisan group within Congress, within the House at least, and maybe in the Senate, but certainly in the House, who know that this is an this is a problem that has to be addressed, and it's bipartisan. Uh, Joy Arrington who's the head of the Budget Committee, other congressmen, both Democrat and Republican, know this is an issue, and they're trying to get agreement, get a bill passed where they then put a commission together that says, all right, how do we address our emerging debt crisis before it becomes a crisis? How do we begin to rein in our debt? How do we do this? And we know it's challenging. We know we have entitlement programs that are indexed. So that underway of trying to get a commission put together to address that. That is, at least to me, a sign of hope that you have both parties, members of both parties, doing that. Now they're up against a lot of pressure too. I mean, as congressmen, you still have to pass that spending bill. Do you say no and infuriate the other politicians and the White House that might be involved in this? So it's not. I'm not saying that it's an easy thing, but it is at least being recognized by important members of the Congress going forward. And I would tell you, the other thing, and this will be one of Kevin Warsh's major challenges. The Fed under Paul Volcker, for example, went to Congress and said, "You have a deficit problem. I cannot monetize this debt for you. You've got to begin to pay attention to this." And in his period, that's when reserves actually declined, and we had very high interest rates because he had to rein it in before it became out of control. I also point out that there's hope because in the middle of the 90s, the problem wasn't as big as it is today, but we had a debt deficit problem. And a Democratic president, Bill Clinton, and a Republican Speaker of the House, Newt Gingrich, despite their differences, came together and put a plan together. It was a 7-year plan to balance the budget, and they did it in 4 years. What this bipartisan committee wants to do is get the deficit down from 6% to 3%, because they think if they can get it down below 3%, then the economy and can grow us out of our debt dilemma. That's their hope. So yes, there's a ray of hope. There's some history as precedent, but it's still a long shot.
All right. Well, we're looking forward to sunshine or morning in America again.
Yeah.
You get us together. I would add to that, Tom, my one glimmer of hope here is that we saw how unpopular inflation was in 2021, 2022.
Yep.
And that's what's going to happen if we don't get our act together. Higher trend inflation, not just a 1, 2 year pop, but it's going to be a higher trend rate. If the public does not like it, then the appetite for reform might go up. We might see some change. So
I think that's right. I think that's a pressure point that is there, and I think people were talking about 3% being the new normal. I think that people are not reacting well to that. That still means their cost of living is going up more rapidly than they
yeah.
expected. So I think there'll be a lot of pressure to bring it down to 2%, both in Congress, in the White House, and certainly within the Fed.
All right, so let's circle back to Kevin Warsh, our new Fed chair. So he's coming in. We've already touched on some of the challenges he faces. Let's talk about his agenda. So he has some ambitions, some things he wants to do, and you outline them in your piece again. You mentioned communication strategy, relationship with Treasury. Let's start with those two first. What's going on there? What is he hoping to do?
Well, I think communication. I think Kevin realizes, as I've talked to him in the past, that forward guidance is an interesting tool. It may set expectations, but that also makes it a dangerous tool. And
Mm,
this dot plot and this forward guidance, when you do that, we've learned. I learned when I was there, sets expectations. So if you say we're going to, Chairman Powell at one point and others, Bernanke before him, but Chairman Powell said, "Well, I'm not even thinking about raising interest rates." You set expectations, and people react to that. They invest accordingly. Banks go longer on the yield curve, and so you create your own future problems when you do that. And I think what Kevin wants to do is say, "Here's what we know today. Here's why we're doing our action today, and we're going to watch things carefully." And that's it, because he recognizes, and I think many members of the FOMC recognize, that the Fed can't tell the future any better than the markets. It's, you're gambling, and when you set those expectations, you tie your hands. And when circumstances change, you can always explain it. Circumstances change, but you set the expectation. So I think that's very important for him. And I think the other element is independence of the Treasury. Everyone's talking about the Fed Treasury Accords. Uh, it means, as you and I have talked ourselves about, it means something different to every individual who you ask the question of. So let me give my definition, and that is that that the Treasury understands that its job is to manage the Treasury debt. It's not the Fed's job to manage the Treasury debt. And I'll come back to that in just a second, because it's very important. So it's the Treasury, and the Fed's job is price stability and managing towards price stability, and through that, maximum employment. Now, what has happened, I think, over time, is the Congress, the Treasury, and the Fed itself has introduced for itself a new mandate, and that mandate is a smoothly functioning treasury market, a market that is liquid. And who better to assure that than the Fed? But that's not the Fed's job, is it? That's a self-imposed mandate. It's the Treasury's job and Congress's job to give us a smoothly functioning Treasury market by not having so much debt that the markets can't absorb it, and you have to turn to the Fed. And that's what's missing. So a new court says, okay, we know our responsibility. Here's what we're going to do. We're not going to do it overnight. Took us years to get here, but we are going to slow the growth, if not reduce the size of the balance sheet. We're going to slow the growth of the balance sheet. And for us to do that without interest rates rising dramatically, we do it slowly, but it also requires of Congress to manage the debt and deficit so that the Treasury then can manage the debt market without having to turn to the Fed to buy the excess amount of Treasury debt. So a huge challenge. I think Bessent and Kevin Warsh have to agree on that first and foremost, because they've got a lot of different people that have to convince that that's the best policy for the long run.
Yeah, great points. Let me go back to the communication point that you raised a minute ago, where he wants to do away with forward guidance. And I think what you're alluding to is he wants to do away with this what's called the dot plot or the SEP, which is the forecast of all the voting members, I guess all the members of the FOMC.
Yeah.
And again, it's supposed to be a conditional forecast, but it ends up being viewed as an unconditional forecast. It's good as gold. And so is that what he wants to get rid of? I mean, is it practically get rid of the dot plots? Maybe also fewer press conferences. What's your impression of the concrete steps he would take?
Yeah, he hasn't spoken about it recently, but my impression early on was that the dot plots he sees as setting expectations, and they're based on. I mean, every member has his or her own model.
Yeah.
They have their own biases. So this dot plot is what they think will be based on what they think the economy is doing and how the economy will go forward. So you have these 19 estimates or guesstimates, depending on how you think about them, being plotted out there. And then the market said, oh, man, they think rates are going down. They think rates are going up. The economy is going to grow. But, they're basically saying, I think that's what's going to happen, but I don't know for sure, but I'm going to put that out there. Well, in the end, that causes more difficulty than it does solutions. Now, Wall Street may object to that because you can place bets on that. But the fact of the matter is, I think it causes more difficulty. And I think Kevin thinks that as well as he goes forward from here. And I think on the press conferences, I don't know. I kind of wish it would go back to, when there's something to announce or every other meeting to where you're not, because I think one of the difficulties is it takes attention away from the committee's view and makes it more the chairman's view. And I don't think that's necessarily a good idea for really communicating with the markets about where the FOMC is as a committee.
So you would be someone who supports the presidents of the banks to continue doing their interviews and sharing their views publicly. Yeah.
I would. I give more credit to the public, and I give a lot of credit to the market. They'll take it and they'll use it based on, it's clearly, this is my view, giving a speech. It'll be much healthier for the Fed and much healthier for the markets, I think, in the long run. Yes.
Yeah, I think the saying "Let 1,000 flowers bloom, let 1,000 models bloom." Each of the members of FOMC share their views, and you're right. People get paid big bucks on Wall Street to take those speeches and dissect them 1,000 ways and tease out whatever they can from it. So, I do think it's useful to communicate and to try to articulate what's being said. A few other things. So we talked about communication strategy being something that Warsh wants to address. Some new Treasury Accord, Fed Treasury Accord. We touched on it earlier, but he said a lot about balance sheets. So let's go back there for a minute. What do you think he really wants to do, and then what can he do?
Well, I really think he would like to shrink the balance sheet, but I, and I wish he could. I
Hmm.
prefer smaller balance sheet, a smaller footprint, and but how do you do that? Especially when you have all this debt coming on board, you have all that pressure. What I'm hoping he can do is slow the growth of the balance sheet. Um, for example, since December, the balance sheet has, as I said, has grown, and its purchases of treasuries have been about $200 billion. A little bit of a reduction in the mortgage-backed securities, but the difficulty is, um, if he were to say we're going no growth in the balance sheet, we're going to shrink it, you would have a financial liquidity problem on your hands very quickly, because the demand for this liquidity in the market as the debt is being issued is pretty significant. And so you can't just say, no, we're not going to do that anymore. You have to say, we're going to slow the growth. But if you look at the growth from December to today, the average rate is somewhere about on an annual basis, that is about a 14% growth rate. Well, that's that's more than that's more than enough. That's back to quantitative easing, which has happened, and that's why you're seeing some of the interest rates going towards the low end of the range for the Fed. So, he needs to make it clear we're going to slow the growth in the balance sheet to the extent that we can over time, to allow the Congress time to reduce the national deficit over time, and that'll allow us to print less money and allow the market to function and allow banks to take on more of the a percentage more of the national debt, and allow the Fed to take on less. And that would be, I think, uh, a successful program for Kevin Warsh and the FOMC.
Yes, if I'm hearing you correctly, Tom, what you're saying is a lot of these proposals, including ones I've suggested, but a lot of them ranging from adjusting liquidity regulations to making the discount window more accessible as stigma to doing any number of things, doing an asset swap at the Fed and Treasury. All these things make give us some more space. Maybe it extends the runway a little bit, but at the end of the day, you got to get the fiscal house in order. Otherwise, those things are just kind of like they're padding.
They help it. They help in a temporary sense. For example,
Yeah.
um, if you were to try and if you just switch assets, that doesn't reduce the size. It
Yeah.
changes the allocation. If you ease on the liquidity ratios, you could probably do that to a point, but after a certain point, you're now endangering the liquidity framework of the banking industry. They've also reduced the capital requirements. That allows you to lever up more so that you can buy more of these. But how much leverage can you take given what we learned in the great financial crisis? So yeah, they're what I call salve, but they're not the solution.
Mm,
They're not what
yeah.
heals the wound.
Yeah. Needed a deep, wholesome inner healing, not the symptomatic
Exactly.
fixes. Okay. Um, what about also you touched on this, but just to be explicit, because you have it in your essay, his views on crisis era interventions. So you mentioned, for example, the really aggressive QE that was done during the COVID period, not just in treasuries, but also you mentioned corporate bonds and other areas of the market.
Yeah. Well, the issue is in a crisis, whether it was the 2008 crisis or the COVID crisis, the Fed, central bank, should step in with liquidity solutions. Um, Now, does it have to do as much as they did in COVID? We can debate that. But I accept the idea, and I think Kevin accepts the notion that in the crisis, you provide liquidity into the market. That's a form of QE. But where the issue becomes more controversial is, when does it end?
Yeah.
So I got kind of crossways with the other members of the FOMC, and a couple of my colleagues did too, when we said in 2010, wait a minute, you're doing another QE program of tens of billions of dollars, and the economy is in recovery. You're going to misallocate resources. Do you really want to do that? And they said yes, they really want to do that. And unfortunately, that has also taken place under COVID. So we had this crisis in March of 2020. The Fed stepped in, but the worst of the crisis was over by August of 2020. And yet, $120 billion of new money, that is the Fed purchasing government debt every month, all of 2021 and part of 2022 continued on. So they flooded the market. They flooded the market with excess reserves, so much so that they had to use reverse repos to remove some of it, so interest rates wouldn't go negative. So that's a really beyond the scope of what a central bank should be doing in, I think, any instance that I can think of in time. When the economy is in recovery, you don't use emergency vehicles to somehow boost it a little extra, because all you get is inflation or misallocation of resources or both. And Kevin gets that. He saw it in that meeting. In the 2010 period, he ended up resigning. I think part of the reason he resigned, he didn't want to be a part of it, and he knows it today. And he also was critical of it after the COVID. So now the reins are in his hands. My point. So he needs to, I think, deliver on what he already knows to be a fact. You cannot do exceptional monetary policy and have normal times.
Yeah. So in the time we have left, anyone in the audience have questions for us? We'll take them. You can go down into the chat room, I believe, at the bottom of the screen there, and ask a question for Tom or me, and we'll be happy to take it. We got about 10 to 15 more minutes to go. And Tom, just going back to this point you made about doing QE or asset purchases and during recovery times, something that I think is important to know, and this also ties into the earlier point about the size of the Fed's balance sheet, is even though the Fed's balance sheet did shrink from almost $9 trillion to a little over six, where we ended up in terms of reserves, it's higher than it was before. And every time we've done QE, there's a ratchet effect in terms of the stock of reserves in the system. And so there's been work done on this, but for whatever reasons, there's a ratcheting at banks, the demand supervisors, it affects the structure of their liabilities, but banks themselves begin to depend and expect higher and higher levels. And this actually can be problematic, right? Because the Fed's balance sheet gets bigger and bigger, more
Exactly.
expectations for the Fed. It actually creates potential fragility in terms of the net liquidity in the system. So it's something that needs to be addressed, I think, because long term, you can't forever grow the size. And I'm not just saying absolute size, dollar size. If you look at reserves as a percent of GDP, again, where they are now is higher than where they were, pre-2020.
Absolutely. And I would tell you that one of the issues around that is every time you make these changes, you do this zero interest rate, and you set a new equilibrium point. The economy has an equilibrium around the new balance sheet, around the interest rates that are set with that new are influenced by that balance sheet. And so when you have an equilibrium, and then you're going to go back to what you think of as normal, there's a new equilibrium that has to be established on the downside. And growing the balance sheet, there's a lot of winners, a few losers.
Yeah.
When you're shrinking it, there's a lot of losers and only a few winners. And so that's why it becomes increasingly difficult, as we've witnessed, to ever shrink.
Yeah. And I think that's where I've done some of my work, is like, what could we do to automate QT so that when we're done with QE, again, there's a time and place for QE if markets are crashing and stuff, but when we're done, that is completely unwound. We completely reverse it.
Absolutely. And I have to make this one point, and that is, after the 2008 crisis, when the Fed went in and bought mortgage-backed securities and put them on their balance sheet and grew the balance, when 2010 came, for example, mortgage-backed securities were on the Fed's books at a premium, and they could have released those carefully, systematically, and had a gain on the sale. But they decided, no, instead of doing that, we're actually going to increase the balance sheet further. And that, in time, played against them. And they got upside down with their balance sheet. And that's why they're marking losses every month now instead of gains. um, from their balance sheet. So the Fed has to think long term, just like everyone else. And when they get bound into the short run only, I think that's when we make some fundamental errors.
Yeah, and let me get on my soapbox here just for a minute, Tom. I do think this is a big deal because if we look around the world, other advanced economy central banks have started a journey toward a smaller balance sheet. Now, to be clear, they're on a journey. Their balance sheets are also large, but they see the benefit of shrinking and going to what's called demand driven. Let the banks themselves determine it, but get the banks in a place where they can shrink the amount of demand for reserves that they want because they want to do two things. They want banks to ultimately drive the amount of reserves in the system, not have the Fed front load the system with reserves.
Very good
But
point.
secondly, they also want to see a resurrection or at least a healthier version of interbank lending overnight.
Yep.
We don't have that in the U.S. And you might say, what's the big deal? Well, the big deal is that it's a market that now is effectively missing. We like price discovery. There's a place for that. There's a place for other things too, prudential regulation, but banks disciplining other banks. We just simply don't have that in the U.S. And what's interesting is like the ECB, the Bank of England, they want that. They want to get back at that.
Yep.
And I think I'm hopeful. You mentioned you're hopeful about debt. I'm hopeful we're beginning to see cracks in the armor of ample reserve advocates, or at least they're acknowledging that there is some desire to shrink. So I'm hopeful we'll have a conversation under Chair Warsh about the Fed's balance sheet. We had the framework review about the target, inflation target. It would be great, and I think maybe Kevin Warsh will do this, have a review about the balance sheet as well as operating system.
I think you're absolutely right. I think that's a great point and something that the Fed really does need to pay attention to. You're absolutely correct on that. Yeah.
All right. Well, I don't see any questions coming in. So, Tom, maybe I'll give you the last word here, your closing thoughts to our audience.
Well, thank you. First of all, I appreciate everyone being on the call. And if you have questions, email David or me individually, and happy to try and answer them later. But my point is, we have a new chairman. He is experienced. He knows how this works, and he's also a very good diplomat. So I have hopes that the Fed will be led well. He will be under enormous pressure, and I think his skills and those supporting him need to be thinking long term. And if they do that, we have a I think a strong possibility for a brighter future, both on the monetary front and on the debt front. And I have to say also, we have a very fragile economy. And so I think care is something he has to have in mind, and he does. And we'll have to follow it and be patient as he tries to work through it, because the next 12 to 18 months are going to be difficult months for all of us. So I wish him all the best.
All right. Thank you, Tom. Thank you, listeners.